Huntsville, Alabama, where the rockets go up and apparently so does the homework required before buying a rental property.
That's Farineta's beat exactly. Today we're looking at what's actually driving Huntsville's investment market in 2026, the employment anchors, the rental strategy shifts, and what location analysis means when the market stops rewarding speed alone.
Let's start with what's changed for investors and why strategy is the new speed.
The core argument here is that Huntsville has crossed a threshold from a boom-driven market where almost anything appreciated to one where the fundamentals of a specific property determine whether it actually performs.
The Post puts it plainly. The biggest trend investors should recognize in 2026 is that Huntsville is becoming a more mature investment market. The days when nearly every property increased significantly simply because demand was high have changed.
What that means in practice is that investors can no longer rely on a rising tide. The upshot is that location, rental demand, and financial discipline now do the work that general appreciation used to do for free.
And the employment picture is what keeps Huntsville from just being a cautionary tale about a cooling market. Redstone Arsenal, NASA's Marshall Space Flight Center, Cummings Research Park, the Post names all of them as active drivers of housing demand, not historical footnotes.
Job diversity is the key point. When housing demand connects to aerospace, defense, technology, healthcare, and manufacturing simultaneously, a slowdown in one sector doesn't hollow out the rental market the way it might elsewhere.
So the investor who used to ask, is Huntsville growing, now has to ask, is this specific property near where Huntsville's growth is actually happening? That's a harder question, which is probably why the Post spends so much time on location analysis.
Right. And the surrounding communities get real attention here. Madison, Athens, Harvest, and Meridianville are all named as areas investors are watching, not just for current prices, but for infrastructure improvements, new schools, and commercial development that haven't fully priced in yet.
Buying ahead of the road expansion rather than after it, the oldest trick in real estate, now requiring a spreadsheet and a local expert to execute without guessing.
The Post is direct about that tension. Technology tools can surface price trends, but they can't explain why one neighborhood outperforms another. Local knowledge fills that gap, especially around zoning changes, builder reputation, and upcoming development timelines.
Rental strategy gets its own weight here, too. Single-family homes, particularly 3 bedrooms with garages and updated kitchens near employment corridors, are described as the practical core of a Huntsville portfolio right now.
And the Post flags build-to-rent communities as both a signal and a complication. Their growth confirms rental demand is real, but individual investors need to account for how additional professionally managed supply affects their own pricing position in a given area.
The closing argument lands on patience and financial realism. Properties need to cash flow today, not just appreciate eventually. And the investors most likely to succeed are the ones treating rental homes like businesses rather than passive assets. That shift toward professionalization, better tenant screening, maintenance planning, realistic expense budgets, is positioned as the defining habit separating 2026's successful Huntsville investors from those who are still operating on 2021's assumptions. Strategy over speed, fundamentals over momentum. Huntsville's market is asking investors to do more work, but the underlying demand is still there.
Next time, more on what that demand looks like from the buyer's side. Stay with us.